Okay, hi, this is Jill. I'm the Braille instructor at Society for the Blind. We're doing our live seminar today with Dustin Buck, who is a financial advisor. And I think he's been doing that since what, 2004, if I read correctly. He's going to talk about several things: retirement, everyday funds, and what we'll do is
Did you see
I
what you're
guess,
looking for? Yeah.
I guess I have to
Oh.
ask if you
Oh,
all
yeah.
could mute your audio.
I was looking at your Facebook.
All right. Hopefully that's better. So he's going to talk, and then we'll have a chance for questions during each little subject that he covers. Um, so if you could, wait until that time to ask your questions, that would be perfect. So Dustin, do you want to introduce yourself and tell us a little bit about what you do and who you are?
Sure thing. Well, thanks for having me, Jill. So my name is Dustin Buck. I live in Fair Oaks, and I have an office in Fair Oaks. I'm born and raised in Fair Oaks as well, and I'll probably be here my whole life. So I did start in the business in roughly 2002, and that was right after the dot-com crash, if you remember the big debacle that happened in 2000 through 2002. So I started, and then I moved back to Fair Oaks after a couple years of undergrad at Sonoma State, and I opened an office in Fair Oaks, and I've been doing financial planning ever since. Went back to grad school at one point, back to Sac State to do an executive MBA program, just to be a better business owner. But I've always wanted to do this, and this is the only job I've ever applied myself to since I was 15 years old, when I had the desire to become an advisor. So I work with mostly individuals at this point, and mostly people who are approaching retirement or are in retirement. I also help some business owners with business planning as well, which makes up about a quarter of my business. And so I do manage some 401ks and some other company retirement accounts. But most of my clients are just interested in making sure they are planning for their own retirement, and that are hopefully not going to outlive their money. But this job gives me the ability to be able to do a lot of teaching, and I love the teaching part of this job. So if you guys have any questions throughout this conversation, you can interrupt me at any point and just ask the question, just so in case you don't forget the question. But what I thought I'd do today is just maybe go through 6 different topics to address that might have to do with financial planning and some things to consider as we're in this pandemic. So there are some things that individuals can do to work on their own situation and maybe improve their situation. So the topics I'm going to cover are going to be building an emergency savings and the benefits of an emergency savings. Next, I'm going to talk about debt strategies. So maybe a good time to reconsider your current debt strategy. I'm going to talk about budgeting, and this time it might be a good time to look at and do a budget makeover to get a handle on where your money's going, because that is one thing that people can control. We'll talk about investing and the different avenues to invest and what to consider with the election coming up, and where the market is now, and if you were to invest, what are good places to consider investing. I'll talk about refinancing. So if you have any debt currently, especially a mortgage, could be a good time to look at refinancing. And then I'll talk about also giving back and other things you can do for the community to try to help others through this time, because there's a lot of folks that are in a lot of need, and this, depending on how long this pandemic drags on for, there's likely going to be more pain before things start getting better. So there's maybe some few things I'll bring up that folks can do to give back to their community. So those are the 6 main topics that I'd like to cover, and each topic I figured I'd spend maybe 5 to 10 minutes talking about, and then I'll open it up for questions and comments at that point. But on top of that, I want to just make sure I'm going to address any topics, any other questions that anyone has above and beyond those 6 topics. So as of right now, is there any questions that anyone has, or any topics that you're going to want to make sure I address on this call? And there's nothing is off base, off or out of bounds. So anything that you would like to learn about or you'd like to discuss?
I have a
This is
question.
Diane. Oh, sorry.
No, my name is Stefan Smith. How do you when you're thinking about refinancing or getting another piece of property for investment for maybe retirement for income? How do you do evaluation on that?
Okay, good question. Make sure we touch on that through this call.
And
What
the
other?
other question I had, you might discuss the difference between a Roth IRA and a regular IRA.
Perfect. Make sure to cover that in the investing part of our discussion here. What else would you guys like to touch on, or what other questions have you had that you'd like to bring up?
Yep, and I got the second question. How do you know in today's currency how you can understand what you need to save for 20 years from now?
Okay, perfect. Good, very good question. So kind of projecting forward, if how much do I need to plan on being able to save, knowing that obviously inflation or the cost of goods or the cost of gas and food, that's going to continue to increase over time. So how do you make sure you save enough that you're going to be able to keep up with inflation at least over time? What other topics or questions would you like to throw out there? All right, so I think I'll just jump into the first topic, but if anyone has any thoughts or questions at any point, like I said, I have no problem with you just interrupting me and chiming in, and I'll make sure we address it then, or if I think there's a better time to address it on the call, I'll maybe table it until that other time. So first, let's talk about emergency savings and how to build an emergency savings. So the rule of thumb in the industry is to try to save at least 3 to 6 months worth of living expenses for emergency. Now, obviously things come up and life happens, and sometimes you have to replace a transmission in a car, or you have to have medical expenses that pop up, or a variety of other types of expenses. So if you figure on average, and I'll just use hypothetical numbers here, but let's say you're spending $3,000 per month of total expenses. So the rule of thumb would be 3 to 6 months worth of savings. So if you're spending $3,000 per month, a basic rule of thumb could be to try to save between $9,000 and $18,000. And that would be something that's liquid, so not a retirement account where there might be a penalty to be able to get access to the money, but just in a savings account. So the downsides to having a savings account is, let's say you're making only 1% interest in your savings. My personal savings at my bank is only paying a little bit less than 1%. So if you're making less than 3%, for example, your money in your savings account is actually being worth less in the future than it is today. So if you're not making at least 3%, then your money is really losing value over time. So that's just something to consider there. And I apologize, guys. Okay, I'm going to have to switch over to a different phone here in a second as my headset's starting to die. So I'll get that all set, and I'll just keep talking here for a couple more minutes. But I will call in from a different phone number here, and I'll be able to keep talking if that's okay with you guys. So, again, the negative to having a bunch of money in savings is that your cost of living is going up at close to 3% per year. And so if you're not making at least 3%, your money is starting to lose some value by being in a savings account. But at the flip side, it also gives you the ability to better plan for any large expenses that might pop up. So, I have some clients that are perfectly fine keeping $1,000 in savings because they have a pretty steady income and they're not too worried about it. And I have some clients that need to keep a whole bunch of money in savings just because they're really worried about what could happen, and they just can't sleep at night if they don't have very much money in savings. So everyone's a little bit different. So there's no flat rule that everyone needs to. Oh, sorry about that. Okay. Okay, one second here. Okay, can you guys still hear me okay?
Yes.
Okay, all right, I'm sorry here, I've switched over to a different headset, so.
Yeah, I hear you.
Okay, great. So for emergency savings, again, 3 to 6 months worth of savings built up is a good rule of thumb. And how to save the money, obviously, putting money in a bank account or savings account is usually the easiest place to save. And obviously knowing that banks don't pay that much money, sometimes you want to keep just enough that you're comfortable with, and then there might be something better to do with the rest of the money. So having that emergency fund can definitely help with the uncertainty that can come up, and the uncertainty right now is how long is this pandemic going to last, and what is that going to look like? So any questions about anything I just covered there? Okay. And I'm sorry I had to jump into a different headset there, so I hope I was able to convey everything to you guys through that conversation there.
I have a question.
Yeah, please.
So, is there a golden rule for approximately what percentage of your income you should be saving?
Yeah, it's a good question. So there's a couple different golden rules that I've heard of. Probably the most common rule is the 50-30-20 budgeting rule. And we will talk about budgeting and some tips I have in a minute there. But what that means is 50% of the money you earn or you make should be used towards needs. So your needs are groceries, housing, utilities, health insurance, car payment. So 50% on your living expenses and needs. 30% can be spent on your wants. So that could be hobbies, dining out, shopping, travel. And then 20% would be saved. So I've heard before between 15 and 25% is the best practice for how much of your total income should you be saving. Good question though. Any other questions about building an emergency savings? All right, so next topic would be debt strategy and looking at your debt strategy. So carrying debt, especially high interest credit card debt, is never advisable, but sometimes life happens and people have to do that. Credit cards that are charging 20 or 30% interest make it extremely difficult for the borrower to ever pay back. So if you can do your best to limit those credit card and discretionary expenses that you're putting off for the future, that's obviously ideal. There are a number of credit cards that offer 0% interest or very low interest rate for a trial period. So it could be 6 months or a year. And they could say, if you're going to transfer a balance to us, if you have $5,000 on credit card X and you want to transfer that over to us at credit card Y, we will have a 0% interest rate for the first 12 months, for example. So that could be a good way, if you do currently have any credit card debt, is continue to look around for cards that might be a much lower interest rate or offer some sort of trial period. And a lot of cards are offering trial periods right now where they will waive the interest typically on any balance transfers. So looking for a low interest credit card is ideal. If you have any student loans, the government did suspend most payments through the end of September, and hopefully that provided some temporary debt relief. And there's a chance they could extend those forbearance or the suspension for another time period. I wouldn't be surprised if that happens or if it restarts at some point. So, but with all the stock market volatility recently, interest rates have fallen pretty sharply. So it is providing a little bit of buoyancy and help to those that do have a lot of debt currently. Any questions about debt and debt strategy currently? Okay. Next topic is budgeting. And most people don't do budgets, but budget is something that you can control because it's hard. Sometimes we can't control the stock market and we can't control who's going to be in office. We can't control a lot of things in this world, but we can control where you're spending your money. So I recommend everyone does a budget, regardless of how much you're making or how much you're spending, because it's really hard to know where your money's going unless you're really looking at a budget. Dave Ramsey, who is one of the more prominent voices in the financial planning community, does a lot of education. He once said, if you don't tell your money exactly where to go, your money will disappear. So going through the process, and it's painful. It's painful to do a budget because you actually have to do a lot of math to kind of figure it out. And a lot of people just really hate numbers for the most part, which is one of the reasons I have a job. But it can be as easy as just taking a scratch piece of paper and just writing down your expenses. At least you're starting to build a budget. There are a number of budgeting tools that are available for free online. So if you just Google search free budget template, there'll be 100 examples that'll pop up. And oftentimes you don't have to subscribe to anything. There are just a lot of basic templates online already. So if you want to find a basic template, it shouldn't be too difficult. Another way that I've recommended that people manage their budget is they use an automated tool. For example, there's a program called Mint.com. So Mint has created an automatic budgeting tool, and you can, if you want, you can link your bank account or you can link your credit card or your any kind of debt you have. You can link those accounts directly to your Mint account. And each month, expenses and income will automatically flow in, and you can even create specific rules for those to make it easier. So my wife and I have a Mint account as well, so we can keep track of everything. And each month I know that there are expenses for daycare, for example, for my daughter. And I went in and I just edited that rule so that every time Mint sees that X amount of dollars leaves my bank account as an automated check, it automatically drops that dollar amount into the quote daycare bucket for the budget. So it takes a little while to get a tool like that set up online, but once you get a tool like that set up, it's just a way to automate the budgeting situation. The hardest part is once people do a budget is really following up with it and keeping track of how the budget is doing. So if you can make it as easy as possible and have automatic rules kick in, that would be ideal. But for those who don't want to use a program like Mint, or oftentimes a lot of banks offer the similar type of program. So one of the banks I use is Safe Credit Union. And they actually have financial planning tools, and they have a budgeting tool that's free for any Safe members. A number of other banks I know have similar options. But if you don't want to use an automated tool or an online tool, then just getting either a basic budget worksheet from the web or just starting to scribble on paper where your expenses are each month, that's the second best thing that people can do. But it takes time to do that. But once you know exactly where your money's going, then it can give you a lot of power to decide, hey, if I have any extra money, what should I do with it? So it's just kind of a basic tool. You know, right now, working on a budget for most people, it's a great time to do it because a lot of people's expenses through the pandemic have gone down as well. People aren't traveling as much and they're not dining out as much. So a lot of people are saving a little bit more money now than they were prior to the pandemic. Obviously, if your income has changed, then then obviously that affects the net amount as well. But it could be a really good time for everyone to go through, and if you've already done a budget, just pull it back up and just make sure it's as accurate as possible. And people say, well, gosh, Dustin, do I need to put every penny of where I'm spending my money? Do I need to enter that in every single month? Typically not. So even if you can do 80% or 90% of what your budget is, that's pretty good, and that would be good enough for most people. Because at least you will then have a little better idea of where your money is going. Now, through the budgeting process, most people determine that they are spending more money than they thought they were, whether that's eating out or travel. Those are usually the categories where people typically underestimate how much they're actually spending. So you got to be vulnerable going through a budgeting process, and you got to try to be as honest with yourself as possible. But once you do a budget, then you know where your money's going, and it gives you just much more control in the future. Any questions about budgeting? Okay. And then we'll talk about some investments. So I'll maybe touch on what you could do now and then where could you put money. So when there's a lot of volatility in the market, and volatility means big ups and downs in the stock market. So when that happens, the best way to invest is to what's called dollar cost average. So each month, if you put in the same dollar amount, let's just say $100 a month, it's just a round number to put in. So if you put in $100 every month, when the stock market goes down, then your same $100 buys more shares of whatever stocks you're buying. And then when it goes up, your same $100 buys less shares on a monthly basis. So your dollar cost, you're averaging yourself into the stock market over time. So you're not waiting until one point during the year and saying, okay, is the market higher or lower? Is today a good day to invest, or is today a bad day to invest? It's often just a better idea to not try to predict whether you think the market's on sale or overpriced, high or low, and it's better just to put in the same amount every month if possible. So places to put money away. One question was, should I do a Roth IRA or a traditional IRA? And there's a number of other types of IRAs. There's what's called a simple IRA or a SEP IRA. But just for the sake of this call, let's just talk about the Roth versus a traditional IRA. So a traditional IRA is very similar to a 401k or traditional 401k. Whereas typically, any money you put into a traditional IRA, you might get a tax deduction on today. And then that money is going to grow what's called tax deferred. So if you put in $1,000 this year and then your $1,000 grows to be $1,100 next year, if it's inside the IRA account, you're not going to receive a bill from the IRS saying, hey, your money went up $1,000, you need to pay us more money in taxes. So you're deferring or pushing off the taxes to a later date. So with a basic traditional IRA, you can fund, right now it's up to $6,000 per year if you're 50 years or younger. And if you're over 50 years old, then you can actually do an extra $1,000. So the most you can put in is $7,000 per year into an account. And depending on your tax situation, you might be able to qualify for tax deduction or you might not. But that money will grow tax deferred, and you can leave it invested all the way until you turn 72 years old. And then by April 1st of the year after the year you turn 72, you then need to start withdrawing funds from that account. So what that's called is a required minimum distribution. So they're going to say, all right, Jim, you're 72. We expect you to live to be 92. So over the next 20 years, you have to take out all of the money that you've put into this account and the growth, because we, the IRS, wants all our tax money. So when you're 72, you might have to pull out a very small percentage, maybe 1 or 2 or 3%. But as you get older, you're going to need to take out a bigger percentage of your bucket to pay taxes on. So that they're hoping that right now, if you're 119 years old, you would actually need to pull out 100% of your money. So it's built on people today living to 120 years old. So the goal is, for the IRS standpoint, they want to get as much taxes as possible while you're still alive. So the Roth IRA is the opposite of a traditional IRA. And think of the Roth IRA as like a savings account on steroids. So anything you contribute to the Roth IRA, you could take back out at any time with no penalty, typically. So if you put in $1,000 and that $1,000 grows to be $1,500, and you have an emergency or you just want to pull money out, you could pull out the first $1,000 that you contributed to this account with no penalty. That's where it's kind of a savings account on steroids. And the on steroids part means that that Roth IRA would be invested in the stock market in some capacity, so that it would hopefully make much more than the 1% that your bank account is paying or a savings account is paying. The Roth grows tax deferred just like the traditional IRA. So each year you don't have to report any of the earnings as taxable. And then once you're 72 and 2 years old, anything that you make in the Roth IRA or anything that you have made over time in the Roth IRA is all going to then be tax-free. So people talk about it diversifying your tax situation, or your investments. People say, oh, don't keep all your eggs in one basket. So maybe have some in international and some in domestic, and maybe have some real estate. But it's also good to think about how to diversify your tax situation in the future. Taxes right now are at almost the lowest point they've been in the last 70 years. If you go back to even 1980, for example, if you were making in today's dollars the equivalent of $60,000, and in 1980 your marginal tax bracket, or the highest tax bracket, was close to 60%. Right now, if you're making 60 grand, your marginal tax bracket might be 25 to 28%, maybe lower. So taxes have consistently came down with Reagan and other conservatives in office. Taxes have came down to a pretty low point now. And so we think, well, are taxes going to be higher or lower in the future? Well, there's massive problems with pensions and Social Security. So there's a good chance that taxes are going to go up in the future. So being able to diversify your tax situation and have some money in a Roth IRA and some money in a traditional IRA would be a really good strategy for a lot of people. So I know that's a lot of information in a short amount of time there, but any questions about a Roth IRA or a traditional IRA or any other specific investment type of account?
This is Sam here, and I have some questions. So, can you hear me?
Yes.
Okay, just making sure I'm unmuted. So the traditional IRA was $6,000 or $7,000 depending on your age per year. What is the Roth contribution amount?
good question. So, and then if you have other questions too, I'll address those right after this. But the Roth IRA contribution amount is the same as the traditional amount, but it's an aggregate amount between the two accounts. So you could put in, if you're, let's say, 40 years old, you could put in $3,000 to a traditional IRA and $3,000 into a Roth IRA. If you're 55 years old, you could put $5,000 into a traditional IRA and $2,000 into a Roth IRA. So it's the maximum you're able to contribute to either one of those type of accounts.
Okay, you're creating more questions. Okay, so then the next question is, this money, it doesn't have to be earned income, it can be any kind of money?
No, good question. So it is earned income. So if you have investment property income, or if you have Social Security income or pension income, those do not count towards how much you could contribute to an IRA account. And you can only contribute up to the amount of money that you make. So for example, if you have a part-time job and you make $3,000 in a year, you can only contribute up to $3,000 into either one of those IRA accounts. So if you make $3,000, your maximum contribution amount is $3,000. If you make $10,000, your maximum contribution is $6,000 if you're under 50, or $7,000 if you're over 50. If you make $50,000 per year, your maximum amount is still $6,000 if you're under 50, or $7,000 if you're over 50.
Okay. Then my other question had to do with the money in either account upon your demise. Do your descendants or whoever gets the account, do they have the same tax consequences or lack thereof?
Yeah, it's a good question. So even though I'm a certified financial planner, I still can't give you guys tax advice specifically. So this is just kind of blanket advice for people, but not specific to your own situation. I recommend everyone talks to their own accountant to verify and make sure it's going to fit for their own situation. But as far as the distributions and what would happen, so let's say you are 70 years old and you have money in a Roth IRA and you pass away at age 70. Well, then most of the time you can leave that bucket of money to a beneficiary. So it could be a child or a friend or someone else, and you can leave that money to them, and they would be able to likely keep a majority of the money in there, and they might only have to take out a very small amount for distributions, maybe when they turn 70 years old or 72 years old or older. So that's one way that you could leave a bucket of money to someone else that could be tax-free to them. And if you, let's say you turn you're 75 and you pass away then, and you have money in a Roth IRA account, and you leave it to a child, for example, then that child would be required to pull out a required minimum distribution based on their lifetime immediately. So if they're 40 years old, for example, and they inherit a Roth IRA, well, they might only need to pull out 1% per year because they're not expected to pass away for another 30 plus years. So they might have to take out some money, and if it's from the Roth IRA, there's a good chance it's all tax-free to them. So I talk to clients about leaving legacies, and how do you leave a legacy? How do you make a bigger impact in the future? By leaving a Roth IRA investment account to someone else, you're more than likely leaving them a tax-free bucket of money. And knowing that tax rates have gone down substantially from where they've been in the 50s and 60s and even 70s, but there's a good chance that taxes are going to go up in the future. So if you're able to leave a bucket of money that's going to keep growing tax deferred each year, meaning there's no additional taxes on the growth, and then it's all tax-free in the future, that could be a pretty amazing bucket of money to leave to someone else, assuming tax rates are going to go up, which they probably will. So on the flip side, if you leave someone a traditional IRA, or it's the same as a 401k typically, or maybe a 403b if you're in the public space, but if you leave a traditional IRA, And more than likely, whoever you leave it to, if it's not a spouse, then they would have to start pulling money out of that account and do based on a required minimum distribution. And they might have to pull out a little bit of money, and they'd have to pay taxes on that money because more than likely you didn't pay taxes on it when you contributed it into the account. You might have gotten a tax deduction from it. So at some point, the taxes are going to be paid, whether it's upfront, like in a Roth IRA, or on the back end in a traditional IRA. Now, there's a number of caveats that can go into effect as far as when you pass away and how old you are, how old your beneficiary is, what the relation is to the beneficiary. So typically if it's a spouse and they pass away and leave a Roth IRA or an inherited IRA to the surviving spouse, assuming they were 100% of the beneficiary for the account, more than likely the beneficiary or the spouse who's still alive would not have to pull out a bunch of money. They could keep it as their own IRA account and then push off when they have to take the money out from the account. So it gives some a little bit more flexibility if it's a spouse, but if it's a non-spouse, there's a number of other rules about when you could take the money. You either have to take it out all out in the first 5 years, for example, if you're a non-spouse beneficiary, or you have to take it out based on your life expectancy. And then depending on how old you are, it's going to affect what percentage of the account you have to pull out. So it gets in much more complicated tax rules, and I don't want to go into the weeds too much more than that, just to not confuse people. But there's just know that there's a number of rules, and these rules keep changing. So 2 years ago, if you were 70 and a half, you then had to start taking your distribution, and then they passed a new rule and pushed it back to 72 years old before you have to do your distribution. And this year, based on the CARES Act, the government said that no one has to do a distribution. So I'd had a lot of clients that had taken a distribution in January just for their annual distribution because they're over 72 years old. And then when the government said, hey, actually, you don't have to take a required distribution. And by the way, if you already took a distribution, you could put the money back in the account and not have to report it as taxable income. So this year was waived for the required distribution amount, and there's a chance that that could happen again next year. But just keep in mind that these tax laws are fairly fluid, and it changes pretty often.
Thank you.
Any other questions? Yeah, you're welcome. Those are good questions. Any other questions about types of accounts or any caveats with those IRAs? All right, so the most important thing is just trying to put money away, and the type of account is the secondary factor, but the most important factor is just, get to a point where you can try to put a little bit of money away, and even something like 25 bucks a month or 50 bucks a month, if you can get into a habit, you can really start building a habit for investing. That's the biggest key. Because once you establish it, okay, I'm going to commit to 25 bucks a month. And you do that for 2 or 3 months, and then all of a sudden you say, gosh, you know what, I'm okay. I've still got enough cash available, so I'm going to move that up to 50 bucks a month. And then you do that for a couple months, and all of a sudden you say, gosh, I'm still okay. I'm going to move it up to 150. So the idea is that you're going to pay yourself first. Everyone has bills. They owe money to Verizon or Comcast or car company or whatever it is every month. But if you get into a habit of paying yourself first, putting away a little bit of money and do what's called the dollar cost averaging strategy, that's usually the most important thing that people can do to get on track for retirement. One of the questions was, how do I know how much to save and how do I prepare for the future? So there's a number of different ways to figure out what the retirement plan would look like in the future. But typically people spend in retirement maybe 60 to 80% of whatever they're spending prior to retirement. Obviously, some expenses go down because you don't have to buy as many suits for work or travel as much, but other expenses do go up typically, and that would be healthcare type of expenses usually, and maybe some travel as well in retirement. But if you can plan on trying to get enough income to replace 80% of your current income in retirement, then you're going to be better off than most people. So in today's dollars, if you say, gosh, today I'm spending $5,000 per month, just hypothetical amount, and I'm going to retire in, call it 20 years. Well, if you guys remember the rule of 72 from high school economics, you can take 72 and divide it by an interest rate. And that is how you figure out how long money is going to take to double. So we take 72 and we divide it by 3% as far as an inflation rate. So the cost of milk has gone up on average each year, call it close to 3% every single year. So if you figure your expenses are going to go up at roughly 3% every year, you take the number 72 and you divide it by 3%, and that comes out to being 24 years. So if you're spending $5,000 today, and this is just a really rudimentary way of kind of figuring out how much money you're going to need in the future, but let's say it's $5,000 today you're spending, and in 24 years, just to keep your same standard of living, to be able to spend the equivalent of $5,000 today, in 24 years, that number is not 5,000, it's now 10,000. So if you have 24 years before retirement, you just figure whatever you need today is going to double. And then you take 80% of that as maybe a rule of thumb for how much money you're going to need. So if you need $5,000 today, that's going to be the equivalent of $10,000 24 years from now. 80% of $10,000 is $8,000. So then the goal is to kind of work backwards to figure out, okay, well, how do I generate enough income to get $8,000 per month? You'll get some Social Security potentially, you might get a pension, you might have investment earnings, or some people have rental properties. But that's just a way to work backwards into figuring out how much money you're going to need in the future. So if, let's say you're spending $5,000 today and you're thinking about, well, gosh, I'm going to retire in 10 years. How much will I need in 10 years? Well, you figure 5,000 might grow to be $7,000 or so in 10 years or somewhere around there, and then take 80% of that. And that's your new number for how much money you're going to try to back into to try to figure out how much you will need in the future. So again, there's computer programs that do all this math for you. So if you were to ever try to figure out, well, how much am I going to need to spend in the future? You can just find online a financial calculator. So you can just Google future value calculation. So again, future value calculation. And after you do your budget and you figure, okay, I'm spending $3,000 a month now, and I think inflation is going to be 3%, and then you just hit 3,000, 3%, enter, and then it should tell you exactly how much money you're going to need to come up with in the future, however many years out from retirement you are. That's maybe a really basic, rudimentary way to figure out how much income in the future are you going to potentially need. So, and then from there, it's working backwards to say, okay, well, I'm going to get Social Security in the future. I might get this pension. And then that's where you can then try to figure out how much extra money do you need to be putting away into a retirement account or some sort of investment account to be able to grow enough to be some sort of dollar amount in the future that can then help give you that, roughly 80% of your future needs in retirement. So it's kind of a lot of information there. Again, I know as far as numbers go, but that's maybe just some rules of thumb to be thinking about for how much you might need in the future. Questions?
I have a question, back a topic, because my phone would not let me unmute at that moment. I had to leave and come back. About the money you can take without penalty in a Roth. Could you talk about that a little bit more? What you can take out without penalty, or how that works?
Yeah, sure thing. So, and again, I can't give tax advice, so everyone's situation might
Right.
be a little bit different based on their situation. But anything you contribute to the Roth IRA, you
Okay.
can typically pull out without any penalty. So over the
Okay.
years, let's say you put in $1,000 each year for 5 years, and so you've
Okay.
contributed a total of $5,000, and now it's worth $7,000 just because the stock market went up. Well, you could pull out the first $5,000 you withdraw from that account will more than likely not be a taxable consequence to you, because you're really
Excellent.
just taking back the money that you've already contributed. So it's called a
Excellent.
first in, first out deal. And then if you want to pull out additional money on top of that, if you're under 59 and a half years old, there's likely a penalty of 10% to pull out money above and beyond what you contributed to a Roth IRA. Now, there are other caveats that could come into play. So if you do have some sort of emergency situation, emergency health care, some sort of large life-altering situation, losing a job, going bankrupt, there are other caveats that could allow that penalty to be waived if necessary. And again, there's probably 10 different caveats that could go into play there, but got to keep that in mind. And then the same thing with the traditional IRA. If you're under 59 and a half years old, there's typically a 10% penalty for pulling money out early. Plus, in a traditional IRA, if you've received a tax deduction in the past, then everything that you withdraw from that account could be taxable for you.
So what if you're over that 59 and a half?
Then there's typically no 10% penalty. There is no 10% penalty after that, but you would still have to report the traditional IRA distributions as taxable.
Right. Okay, thank you.
Yeah, good questions. Any other questions spurred as a result of that for anyone else? All right, so going back to the investing, again, the best thing to do when there is a lot of volatility like we've had already this year, when in March, you guys remember the stock market went down close to 35%, and we had the fastest decrease and downturn in the market history. It was down about 20% in 20 days, which was a huge shock. So what was happening is the stock market tries to predict what's going to happen in the next, let's say, 6 to 12 months. So the stock market, which only about 1 out of 3 Americans even own stocks currently. So 2 out of 3 Americans don't own any stocks currently. But for 1 out of 3 Americans, they had money in the stock market, and the market went down 30, 35% pretty quickly. And then we followed the quickest downturn in the market history by the best investment quarter we've ever had, best 3-month period ever in history. And since the bottom, the stock market's up close to 50% since March. So if you had a crystal ball, everyone would have sold in February and then bought again in March when everything was 30 to 40% on sale. But no one has a crystal ball, of course. I don't have a crystal ball. Most people weren't predicting a pandemic was going to happen. It was a less than 1% chance, according to the top economists in the world, that we would go through a pandemic. Well, here we are, and it happened. So life happens and crazy things happen, and typically 3 out of every 4 years, the stock market goes up, and 1 out of every 4 years, the stock market goes down. So that's, if you look at your monthly statements, you see that, gosh, 3 out of every 4 months, my account goes up a little bit, and 1 out of 4 months, my account goes down a little bit. It's a really good thing to consider when you're trying to judge if it's a normal situation or if it's not a normal situation. But one of the best things to do is whenever the market is on sale, so whenever it's down and you have a long investment horizon, so at least 5 years or more, usually the best thing you can do is look and see if you have any cash available or any money that's in really boring investments. And that's a good time to try to get greedy when others are fearful and fearful when others are greedy. So I'm going to repeat that because that's probably the best piece of advice to give someone to be able to accumulate a lot of money over time. And I didn't make this up. Warren Buffett made it up. Said, be greedy when others are fearful and fearful when others are greedy. So when the stock market in January and February of this year, when the stock market was at almost all-time highs and we had 10 good years in the stock market in a row, so pretty much one of the best or the best 10-year run in the stock market ever, my conversations with clients were, hey, everyone, we just made 25% last year. And on average, we've made over 10% each year for the last 10 years. Is this normal? No, it's not normal. Again, if we think the market's going to go down 1 out of every 4 years on average, and we had 10 good years in the stock market, then the market was due for some sort of correction. It wasn't going to keep going up at the rate that it's been going up. So my conversation over the last year, up until March of this year, I've been talking to clients about, hey, everyone's being pretty greedy right now. Is it a good time to be maybe a little more fearful? Because people are paying a lot of money for stocks. Stocks are at all-time highs. You know, we've got big problems with pensions and Social Security, so we're just kicking some problems down the road. And then all of a sudden the pandemic happened. And the stock market in February and March was trying to project forward and predict where the economy was going to be in 6 to 12 months. And the stock market reacted really quickly, and it dropped faster than most people would have expected. And it said, whoa, hold on, if we're going to freeze this economy, and companies are going to lose a bunch of money or not make as much money. Individuals are going to struggle and they're going to be pushed to the limit. It's going to be pretty painful if we freeze the economy. Well, we froze the economy, and then you saw what happened. Everything just came to a grinding halt. The stock market crashed as a result because they said, whoa, hold on, this is not going to be good for companies. And then all of a sudden the government jumped in and said, hey, don't worry. I know this is bad, but we're going to write as many checks as are necessary to solve these problems we have. So the U.S. Treasury, along with the European Central Bank and every other country in the world, all said, whoa, this could be really devastating if this lasts and we freeze these economies for a year or more. This will be devastating for a lot of people. So everyone wrote checks. They did a whole bunch of what's called stimulus, where they put a whole bunch of money to work. So in the United States, we've added $3 trillion of debt to the balance sheet for the Treasury. So $3 trillion new dollars have somehow moved into the system. And some of that, a big chunk of that, went to the stock market. So the stock market went up pretty quickly. And there's just a lot more money that's all of a sudden available, and bank accounts are paying 0% for interest. So money had to go somewhere. Money always goes to where it's treated best. And stocks just happened to be that place in March, and therefore we had the best quarter in stock market history after that. And we're up almost 50% across the board in the stock market since March of this year. So clients are asking me, hey, are we going to make another 50% in the next 6 months or 9 months? And my answer is pretty typically, no, not at all. That's not normal. This is not a very normal period in history. So don't expect that you're going to make another 50% over the next 6 months. But here we are in the middle of a pandemic, which again had a 1% or less chance of happening. And so crazy things can happen. So could the market go up another 50%? Well, I guess it could theoretically. I wouldn't predict it though. So that's effectively what's happened in the stock market over the last 9 months, if I had to kind of wrap it up as easy as possible. But when volatility happens and the market goes down and you have money available, again, you want to buy low and sell high, and you want to be greedy when others are fearful and fearful when others are greedy. So whenever you look around and you see people paying more money for stocks than they have on average based on how much those companies are actually making, then that's a good time to say, wait a minute, everyone's being really greedy. Is it a good time to throw a bunch of money at something, and try to ride this wave with everyone else? It might be a good time to be a little more cautious. And the next time we have a big stock market crash, which happened just 6 months ago, right? So the next time the market's down 20 or 30%, which is going to happen, once every typically 5 years on average. Next time that happens, you just got to be ready to get a little more greedy. So if you don't have a bunch of money sitting in cash on the sidelines, which most people don't, you might take that opportunity to look at your own investment accounts that you have and decide if it's a good time to try to get a little more aggressive in those accounts. Those are just some rules of thumb to consider when you're thinking about investing and when is a good time to invest and how to invest. Any other questions about investing or what's going on in the world right now? Any other questions? All right, so next topic would be refinancing. I've had a couple clients that were able to refinance over the last month and a half to 2 months, and they got less than 2% interest rate, a 1.8% interest rate on a mortgage. Right now, people are getting somewhere around 3.25% for an interest rate, which is a fantastic interest rate. The average for mortgages over history has been close to 6% of the average mortgage rate. Does anyone recall what they paid in a mortgage rate back in the 80s? Did anyone have a home they owned that had a mortgage?
I was paying 8% in the 90s.
There you go, 8%. In the 80s, you were probably in the double digits. There were mortgages that were 13, 14%.
Yep.
Now, checking and savings accounts were paying 10, 11%. And bonds, with government bonds, they were paying 12, 13, 14%. So 6% has been about the average over history. So anywhere in the 3s or 4s, those are still really good interest rates. And we're being really spoiled right now with where interest rates are. Extremely spoiled. More than likely, rates are going to probably stay low for at least the next maybe 3 to 5 years. But predicting interest rates, I think, is harder than predicting the weather. It's harder than predicting where we think the stock market's going to be. Predicting rates is probably one of the hardest things that economists can do. So are rates going to go up or down? Well, they really can't go down much more because banks really aren't making much money at all when they're only charging 2% interest or 2.5% or even 3%. Because as I mentioned earlier, the cost of living, so the cost of your gas and food, that's going up at 2.5% to 3%. So if you can get a 3% interest rate on a mortgage or 3.5%, that's pretty close to free money. So if you have the option to refinance, if you're at an interest rate more than maybe 4.5% right now, it could make sense to look at. So there's a number of calculations that go into how do you decide if you should refinance. And Stefan mentioned, well, how do you kind of decide? So usually the best thing is to work with a broker or some sort of mortgage specialist who can look at your current mortgage, look how far you are into your mortgage, figure out how much money you've already paid in interest on your current mortgage, then work out how long you're planning on keeping that property for. And then it should just be a moderately easy calculation to figure out, hey, does it make sense to refinance? Because if I refinance, it's going to cost me $1,000 to $2,000 or maybe $3,000 of total fees and origination expense and new valuation you have to attain. So there's definitely an expense that goes into it, and most people add that expense to the mortgage itself, so you don't really see that expense up front. So, I have multiple people that have refinanced 3 or 4 times in the past 2 years just to get lower interest rates. Well, their mortgage balance most of the time has increased. So if they said, well, I owed $250 and I just refinanced, now I'm getting a little lower interest rate, but now I owe $253,000. How did that happen? Well, there's loan origination expenses or whatever it might be that are tacked on to the loan typically. So you don't really feel it up front, and that makes a loan officer's job a little easier to sell the loan. So just kind of keep that in mind, that there's a number of calculations that would go into, or a number of considerations that would go into determining whether you should refinance or not, but working with a mortgage specialist is usually your best option. Banks have really good interest rates. Credit unions might be a better spot if you're looking at different avenues. So credit unions could potentially give you a little lower interest rate, or looking for a mortgage broker that isn't tied to just one company, that can kind of shop around and try to find the best interest rate. That might be the best option. So any questions about refinancing or the process itself?
What about, I have seen some refis that are true no cost. Matter of fact, I did one a few years ago, and I've seen a few right now. But what about if you just make an extra payment or two a year? Because if you already are at a fairly low interest rate and you don't want to pay points to refi, how would that compare?
Yeah, that's a good question. And who was that? Who was asking that question?
This is Diane.
Diane. Okay, that's a great question. So most of the time, if you were to pay extra towards your loan, you're going to do almost the same thing as if you were to try to refinance to a lower interest rate and pay a higher dollar amount.
Exactly.
So a lot of people are looking at, well, what if I convert from a 30-year down to a 15-year? Gosh, I'll be able to pay it off 15 years sooner. Well, if you keep your same 30-year and you start putting in the difference between what your current 30-year mortgage would be, let's say it's $2,000 a month, but if you were to move to a 15-year, it's going to be $3,000 a month. Well, what if you took that extra $1,000 that you would have been paying if you were to refinance, and you just put that towards the principal? You just write a check every month, a separate check, and say, here's $1,000, and then in the memo section you put principal only. And then that goes directly towards the principal. Your total payoff time for that mortgage compared to refinancing to a 15 years or keeping your 30 years and just paying extra money towards the principal every month, it's going to come out to be pretty close.
Right. Right.
So sometimes, and if you can find a no cost, pure no cost refi, okay, then that could make sense. The question to look at is, how far into your first mortgage are you? Because with a mortgage, how the premiums and interest work, let's say you're starting a 30-year mortgage today and your total cost is, let's say, $2,000 for your total payment. Well, part of that $2,000 goes to pay principal each month, and part of it pays the interest each month. And if you ever look at what's called an amortization schedule, It's really exciting to look at. If you have problems sleeping at night, it's actually a really good maybe sleeping aid I would recommend. But by looking at this amortization schedule, you'll notice that in the first month of you paying, let's say $2,000 towards that mortgage, if you're in a 30-year mortgage, there's a good chance that about $1,500 of those dollars out of $2,000 is purely going to interest.
Right.
Which you never get back, right? So that $500 goes towards principal, and then you fast forward 15 years into a 30-year mortgage, and you're still paying the $2,000. Well, maybe $1,000 of it is going towards principal and $1,000 towards interest. And fast forward all the way to the 29th year of a 30-year mortgage, and you're still paying the same $2,000. Well, probably $1,900 is going towards principal and $100 towards interest. So you pay most of your interest in the first 8 to 10 years of a 30-year mortgage.
Right.
So a big mistake that a lot of people do is they kind of hop around between different mortgages every 2 or 3 years, and they're more or less resetting that amount of interest to principal. And let's say you refinance after 3 years. Well, you've already paid, call it, $10,000 towards interest, and now you're starting a new loan where all that is what's called a sunk cost. It's just money you're never going to get back. You get very little benefits for paying that interest. But that's one of the caveats I see when people say, oh gosh, hey, I just refinanced to this interest rate. I'm now not 4%, now I'm 3.5%. And then I look at what their total amount of money that they would have paid towards principal and interest with their original loan compared to their new loan. Yeah. Well, that's that 5 years of interest that they were paying, that just disappears. So it's just another thing to consider. And that's why really working with a financial specialist, whether it's your financial planner or a loan officer, to run those calculations. Those are just other things that oftentimes loan agents, who are just in the business to sell as many loans as possible, right? After they sell you a mortgage, they're not going to call you 5 years later unless they want to sell you another mortgage, right? So it's a very transactional based business, and their goal is to sell as many mortgages as possible. Whereas someone like myself, as a certified financial planner, I have to do what's legally in the client's best interest before my best interest. So it's just a different type of relationship. But just keep that in mind, that they're trying to make money one way or the other. And even if they say it's a no-cost loan, well, there's a reason why they're doing it. No business does anything for free. It's either there's going to be some sort of benefit to them one way or the other.
The low-cost ones that I did call and check on had a minimum borrow amount, which was higher than I needed to borrow. And I wasn't considering it unless I could go from my 30, which I'm into. I only have 20 left. I would have gone to a 15, but then they have the borrowing limit. So, that's how they kind of protect themselves.
Yeah, there's a number of ways that these companies will make money, either through your loans or through affiliations with other companies, sharing data. I mean, there's a number of ways they make money, but there's a phrase I heard a long time ago, and it says, if money is not the answer, please repeat the question. So you can say, well, why is this bank doing this? Or why is that company doing that? If money is not the answer, please repeat the question.
Mm-hmm.
So
I have a question
out there. Sure.
I have a question about the companies because I did look into extra principal payment. And the really annoying thing is, and I imagine every mortgage holder is different, but this particular one said every time you do that, unless you set it up automatic on a bi-monthly, which is kind of annoying because of how they hold it and how they apply it. Unless you do that, if every time you make a principal only payment, we're going to hold it for 60 days, and they're going to make you do a process every time. Of course, after the first time, if you do it every month, it's going to happen every month. But it was so annoying that they were going to hold that money for 60 days before they apply it.
Yeah, and you're talking about such small margins for how these companies make money.
that it
Yeah.
all adds up. So what they do
Right.
with your money, just like a bank account. So let's say you got $10,000 at your credit union or your bank. Well, they're only required to keep on hand, actually at the branch, roughly, I think it's 10% still. So they're only
Right.
required, and it's even gone down, I think, since then. So they only have to keep, out of your $10,000, they keep $1,000 on hand just in case you want to go and get access to money. Well, if you have $10,000, more than likely anyone could go get 100% of that. But if you had $10 million, you might not be able to get that same day. So what they do with the extra money is they buy stocks and mutual funds and bonds.
Right.
And
Right.
sometimes they buy real estate as well. So they're making, let's say, 7% on the investments, and then they pay some taxes and they pay some fees. And so they might make 3% or 2%. And if they can squeeze out the money and hold on to it for another 30 or 60 days, they're just using arbitrage and hedging, and they're making a tiny bit of money on every one of these loans. If they got 1 million loans, a tiny bit of money each month adds up to a lot of money.
I get it.
So
It's
that's
just annoying when it's
yeah.
my money.
It's true, but again, if money is not the answer, please repeat the question. So there's usually a reason why they're doing that, and no business, even not for profit businesses, or very little businesses actually do things to really help people not thinking about themselves, because the business is often owned by shareholders, and shareholders just want to make as much money as possible.
Mhm.
That's their goal. So management of large companies, their goal is to make as much money as possible. That's how they're judged. So they come up with very creative ways to make more money.
Do you agree with the fact that it's better to make your own principal reduction payment than sign up for the biweekly payment, splitting your payment in half, because they only apply it every 6 months anyway?
Yeah, that's a good question. That's probably loan and person specific. So
Okay.
there's probably not a general,
Okay.
because sometimes I've seen where I've actually recommended that people do their own bi-monthly payments, and some people, based on whatever loan contract they get into, it doesn't make sense to do that, or they're not able to do that. So
Right.
that's something I probably recommend that you talk to your own financial planner or loan officer to kind of work through what makes most sense for you. It's a good question, though.
Okay.
So
Mhm.
Dustin, I'm sorry to interrupt. I know you said you had an appointment at 2 and it's about 2:15.
I pushed my appointment back, actually, so I'm good until
Okay.
2:30 if we want to keep going.
Okay. But I wanted to offer too, and I think we talked about this, that if anybody wanted to reach out to you at a different time to talk to you, they could. Is that okay?
Yeah, that's more than fine. So I myself, by the way, I have retinitis pigmentosa. I was just diagnosed a couple years ago. So I definitely understand that. I think for our low vision community, there's it's a little harder to find resources and access to information. So I want to make myself available. If anyone does want to ask any questions or follow up, I'm not going to talk to you about investments, like types of, investment names. I'm not going to try to sell you anything. As a certified financial planner, I have a legal responsibility to do within clients' best interest first. But even if it's, hey, can we chat for 20, 30 minutes and just, can I run my situation by you and just, you can point me in the right direction, I'm happy to do that.
Okay. If anybody wants the information, they can reach out and let me know, and I'll send it off to them.
Yeah, that's great. So I will be a resource as long as I'm in business for anyone that just wants some help. And if it's a matter of 5 or 10 or 20-minute conversation, I'm more than happy to try to fit that into my schedule. If it's, hey, I really need some help with, I've got these 3 rental properties and I got this business and I've got these different investment accounts, and now we're looking at tax planning strategies and insurance planning and estate planning, and it becomes much more complicated. I'll make sure I tell you, okay, I can't, if I'm going to dedicate that much time, let's come up with something that's fair. So, but for most questions, 9 out of 10 questions, even if you want to reach out and just ask a single question, that's no problem whatsoever.
That's where your name sounds familiar, Dustin. It's Brandy.
Brady?
Yeah.
I'm
Hey,
sorry,
I kept
what was the
your
question?
name. I kept looking at your name, Dustin. And I'm like, I know that name. I know that name from all the emails I sent you for the family support group.
Ah, that's right. Yeah.
Yeah, I
Yeah,
kept going, that name looks so familiar.
yeah, and being in Sacramento and Fair Oaks in business for almost the last 20
Yeah.
years, I've got to know a lot of people, and I try to get my name out there to try to be as a resource for folks as much as
Definitely.
possible. So the
Well,
last
thank
thing
you.
I'll leave you guys with, maybe the last topic, is just what else can you do? And one thing I always like to talk to people on my business card, it says invest, plan, and inspire. And so I love trying to get people to try to do something to try to help other people. So if you are in a position where you can help other people right now, especially with the pandemic that's currently going on, I recommend some simple things. So reaching out, we have in Orangevale, we have the Orangevale Food Bank. And so I recommend, hey, if you're in the area and you have extra canned goods or food, there's a lot of people that need help now. And some of you guys might be folks that are in the process where you actually need help. And so a lot of these food banks are great places to be able to donate canned goods and money to. And then also if you need help right now, I've had a client whose son just went through a food bank in Rockland, and he told me the story. He drove up to the food bank, and he waited in line before it opened, and I think his mom drove him up there, and then they just opened the back door, and they loaded 5 or 6 bags full of food into his car. And he didn't choose what kind of food. It was just, they just gave a little bit of everything, but it was pretty high quality food. And it was an amazing experience where he just walked away thinking, oh my gosh, I've got enough food. I haven't had food in, months off my tiny Social Security. And so now I've got food, and it was all free. It's all donated by the community. So if you're in a position to give back right now, I'd recommend looking at your local food banks as a place to consider giving some groceries. And also if you have any of course, personal protective equipment, whatever you can do to give anything that you don't need away. There's still a big need for that. I also recommend supporting your local businesses. So eating local as much as possible. Most of these businesses are struggling pretty substantially. Mom and pop restaurants. I mean, through the pandemic, if after we're done with this pandemic, if there's 25% or a third of all these restaurants still in existence, I wouldn't be surprised at all. A lot of these have already gone out of business or are going to go out of business depending on how long the pandemic's going to last. So as much as possible, if you can give your money to local restaurants and smaller businesses, just keep the money local rather than giving it to the big corporations. That might be a good option for people, and just to try to help them and help keep doors open as much as possible. Because in reality, this pandemic could last. As far as a lot of these restrictions, we could be in it for another year to 2 years, realistically. I know it's not what most people want to hear. They want to think that it's going to go away immediately, but there's a good chance a lot of this is just going to drag out for an extended period of time. So buckling down and really getting a good handle on your own personal situation, your own finances, revisiting your budget, looking at where your investments are, knowing you want to be greedy when everyone else is fearful and fearful when everyone's greedy, and then look at your debt strategy and try to refinance to lower rates if it makes sense. And then if you're in a position to give back, to try to give as much as you can. So I know I covered a decent amount of information there in a fairly short period of time. I apologize in the first section. I had to jump into a different headset, so I hope I didn't mess that up too much for you guys. But, I will be available. Like I said, if anyone wants to ever email me or call me just to check in afterwards, my schedule is pretty flexible, and I do have times on my schedule that I have for charity and charitable groups. So I definitely have some capacity to try to help people, even if you don't become a client. Again, I'm not going to talk to you about specific products or specific investments. If it's just purely, hey, I just had this one situation with these credit cards, I just don't know what to do and how to get out of it. And I guess one last piece I'll leave with you guys. There's a website, the California State Controller's Office. the sco.ca.gov. So that's S as in Sam, C as in cat, O as in octopus, .ca for California, .gov. It's what's called the California Unclaimed Property. So you can go and you can search California Unclaimed Property by just typing in your name. And there, if any company has ever held on to any money from you, if you ever had money through AT&T or Verizon or someone ever was supposed to pay you back, but then the money will go into the state controller's website. And there are millions and millions and millions of dollars right now that are going unclaimed. So at least 1 out of 3 people, maybe 1 out of 2 people, if I type their name into that search bar, it'll pop up with maybe 1 or 2, or sometimes I have clients that have 20 or more buckets of money that are sitting out there from an old closed checking account or something. So I recommend everyone just Google search California Unclaimed Property.
Well,
California Unclaimed Property, search for your name and see if there's any money there.
All right. Thank you, Dustin. I appreciate you taking the time and coming to talk to our students and staff. And yeah, I think it was some very good, useful information.
Does anyone have any other questions at this point, or is there any other topics that
No? That's great. Thank you.